Hello and good evening, everyone. Thanks for joining us for our special webinar with Jay Soloff. Before Jay comes in, I want to go over the disclaimer. Neither Jay or I are registered investment advisors or is Market Chameleon. This is for educational purposes only. If you have any questions regarding what you want to do with your account or anything like that, you must consult a broker dealer. See this disclaimer on the screen. There it is. I'm going to stop the share now. Jay will be coming in momentarily. And we are doing this show on Zoom, and we also are doing it on YouTube Live. On YouTube Live, I have put in a link to the Zoom. If you want to ask a question, just come on over to the Zoom, and you can ask any questions of Jay or myself. And there is Mr. Soloff, the one and only, the options guru, Jay Soloff. How you doing, Jay?
I'm doing well, Will. How are you?
Awesome. We've got a ton of people on Zoom right now. They're flying into YouTube. Before we get started, and people are still coming in, why don't you give us a little bit of your backstory?
Oh, I'm supposed to have a backstory?
Well, I know it started somewhere on the cold streets of Chicago in a funny colored jacket.
Yeah, no, I was hoping to convince him that you just found me on the street, but probably too many of these webinars in the past to pull that one off. Yeah, I was a floor trader on the CBOE in Chicago, market maker. First clerked in the SPX pit down there, and then set prices for that group. So a lot of time spending looking at volatility. And then I went into the equities as a trader, as a market maker. When things started to go electronic, I kind of switched to the electronic side, worked for a software company that made market making software. So got kind of exposure to the tech side of it, and then screwed around for about 10 years or so, which we will not talk about, with such poor choices as management consulting and business school and some other things I moved to Arizona, and I didn't really have access to derivative world out there. And that was before, remote working, you couldn't work in derivatives if you didn't live in basically Chicago, New York, London, maybe San Francisco, And so I got into, eventually found my way into the financial publishing world. So that's where I am now. So we focus on education. Investors Alley, the company I work for, we focus a lot on education and options. We do newsletters, we do trading services, but I think the key there is trying to teach people. The education aspect is really what I focus on.
Awesome. And tonight you're going to be teaching the Chameleon community about?
So we're going to be looking at basically what I look at when I want to see how the market is measuring risk. So we're going to be mostly looking at SPY and SPY options, but we're going to look at kind of how to different metrics that I and this is stuff that I look at, regularly to, when I want to know what the market thinks of overall risk. So we're going to look at that, and then I'll talk about, maybe some different ways you can trade you can call it hedging or trade, protecting yourself from the downside, or betting on the downside. Could be speculative. It doesn't have to be hedged. So we're going to be looking at some different ways you can do that. But mostly I want to show how I really dig into, because there's just so much you can glean from just looking at SPY options. And I really want to show, because Chameleon's got all the tools that you can really dig into all these different ways to measure it. And I think it's pretty cool. And I like to share what I do there.
Oh, awesome. All right. Well, with that, we will get started. If someone has a question, should they wait to the end, or would you like those as they come through? How do you want to take the questions?
Yeah, if it's directly relevant to what I am talking about, that's fine. I can stop to answer it. Other than that, I'll be happy to stick around at the end for questions as well.
All right. Now, are you comfortable taking a question with a voice live? That's something we do on Market Chameleon at the morning show. We let people raise their hands and ask the question verbally. Are you comfortable with that? Is that okay?
Sure.
Awesome. All right, let's go.
All right. Let me share my screen here then. All right. Everyone can see the beautiful Market Chameleon.
It is a pretty chameleon.
Okay, good. All right. So I'm going to give you the absolute secret right here. There'll be nothing else you'll ever need. I'm going to tell you how to avoid risk. You see, when these lines are going down, you get out before then. Okay. All right. Let's see you guys later. No. Okay. No. All right. So there are actually, there's no perfect way to gauge risk, right? Because if there was, then no one would ever get wiped out during a major dislocation. We wouldn't have all the short vol sellers who got creamed in March 2020, or the people in XIV who got wiped out in February of 2018, or the people in all the mortgage related stuff who got wiped out in 2008. I mean, yeah, sure, there were signs, but we never knew exactly, we never knew when the Lehman moment was going to happen, or more recently, the COVID moment, right? March 16th was when VIX, the volatility index got up to whatever it was, 90 intraday, right? And a lot of these short variance funds got wiped out, and it caused it to, so I mean, obviously these are some of the most sophisticated people out there. And if they can't avoid it, right, you might think that you can't avoid it. Well, that's not entirely true. I mean, to some extent, you should be able to at least see parts of the cracks forming. Now, again, timing the market to the day is nearly an impossible task. If we could do that, then, we'd all be retired right now, living in, wherever Will is with his antlers.
It's a cold barn on a property in Bucks County. It's not
okay.
Not the most joyous place. It's just, that's the one wall with anything on it. The other side of me is pretty scary. So
I was gonna say, you're wearing the jacket. It looks a little chilly.
It's cold here in the barn.
Okay. But seriously though, it's like, timing the market is impossible. However, starting to protect yourself when cracks forming is easy and could really save you a lot of pain. So, like I was saying earlier, what I like to look at is volatility. That's kind of what I learned on the floor, and that's where I spend most of my time. So we'll start with just this implied volatility chart here. And
just a story from Dimitri and I in 08, when things were blowing up. There were weeks and weeks and weeks where you could buy protection. There was so much scary volatility in the market, yet there were still opportunities the whole time to buy and protect yourself. So this is a great.
And I'm actually going to talk about, when we're looking at how to trade it, I'm going to talk about different ways. So if you feel like protection's too expensive, there are ways around that, right? You're always going to have to spend some money, but you can model your trades in different ways to keep from having to overspend, essentially. Of course, if the market's going to crash, then you're never overspending. But again, we don't know if it's going to crash. We just are worried about the downside. So I'm going to turn off options volume here. And let's just start by looking at implied volatility. So something very, very simple. The implied volatility, and I don't remember. I think the our implied volatility is just the at the money implied volatility, and not.
It is.
Yeah. Okay. All right. Yeah. Just double check. So all right. So we're looking at the at the money, essentially the at the money straddle, right? The price of the at the money options in S&P 500 30 days out, right? This is our standard measure of implied volatility. Options, the higher it is, the more expensive the options are, right? And generally speaking, you're going to see, your ebbs and flows. If it's a single name stock, then you might see more volatility heading into earnings periods. For SPY, it might be around, you might see higher volatility around something like an election or a Fed meeting or something like that. Now, of course, this past year, it's a little bit different because we have COVID and you can time some of the volatility to historically time some of the volatility to, spikes in COVID and things like that. But, One thing though, that you could see, and well, it's actually easier if we turn on this moving average, you can kind of see where implied volatility has been, right? And where it is compared to average. So this is where this moving average for the implied volatility. Now keep in mind, I haven't done anything with historical volatility. This is just implied volatility. You can kind of see, where you are in terms of volatility compared to, what it has been for most of the year. Immediately that is a sign, right? So if volatility is much higher than where it has been, you want to say, okay, why, right? So it might be, back here, what is this? I'm trying to remember. Yeah. So you could, I can't remember what this was, if this was inflation scare or exactly what was going on here, but you'll see something rising into, this might have been right going into the Fed meeting. So some of it will be obvious, right? You'll see, again, the most obvious example is seeing implied volatility rise into an election, right? Now we don't have major elections usually every 2 years, right? So that's not going to happen all the time. But if you see, if you see it rising and there's an event on horizon, oh yeah, this was like the debt ceiling and all that stuff. Okay. Along with the supply chain issues and everything. But I think, we were getting close to the debt ceiling and there's a few things going on. The beginning of the inflation scare and blah, blah, blah. So in volatility going up, right? Now, if you see it rising and there's not a necessarily a concrete event coming up, you could start to say, all right, well, are people really starting to worry about, so the buzzword now is inflation, right? Almost everyone's concerned about inflation. The Fed has maybe moved up its timetable. The fixed income markets have really started to move in anticipation of a sooner rate hike than what was initially expected. So if we start to get closer to a Fed meeting or maybe the next CPI report or something related to that, you see inflation, right? You see volatility rising, then you might say, okay, all right, the market is definitely concerned about this. I need to be concerned about it. Right? Now, that's obviously very basic because we're only really looking at one stat here, and that's implied volatility. You can also look at, let's take off the moving average for implied. You can also look at realized volatility. Now, that's backwards looking, right? But if you start to see realized volatility moving up, historical volatility, that means the actual market has been moving a lot more. That's obviously another sign. Now, if implied volatility seems to be ignoring that sometimes is a trading opportunity, or sometimes it's a signal that's just saying, all right, well, the market's moving a lot more, but we're not really worried. So again, these are things that you need to look at and decide. Right now, realized volatility is coming down despite the recent scare with CPI being way higher than expected. Markets actually, realized volatility has come down quite a bit. Now, implied volatility has stayed elevated. So now this is a situation where you're looking at it and you're like, all right, well, realized volatility slowed down, implied volatility stayed higher. Is this something that I want to hedge myself? Is this something where, realized volatility has come down just because the event is over, people have, reduced their positions, and now, we're just waiting and seeing? Maybe this is a good time to hedge. Or is it, market's not even that worried about inflation, maybe I need to sell some volatility, right? So again, these are ways to think through this. We're going to look at some other stuff to help you make that decision. But what I'm doing here is I want you to, this is this thought process that I go through when I look at something like this. I pull the stuff up and I start to ask myself questions. Why is it doing this? Or why is it not doing this? Now, I think there's not a lot that you can get just from this. I like to get into some other areas as well, but this is where I start. All right. So, I mean, if I'm not seeing any volatility or any disparity between historical and realized or anything like that, then I might not even go any further. But this is a situation here. It works out pretty well that we have this webinar today where there's a nice gap between the two. And you have to start wondering, all right, do I need to be scared? Is inflation and I'm going to keep using inflation because that's the biggest concern, the supply chain and the impact on inflation. That's the biggest concern right now. So let's just assume that that's what the market is worried about. Is that why option prices are higher, otherwise known as higher implied volatility? Or are options overpriced right now because historical volatility is going down, right? Realized volatility is going down. So I'm of the belief that the market this is going to stay elevated, right? The market is worried, and maybe we should be a little bit worried, maybe not as much as the news media would want you to believe, but maybe a little bit more worried than what realized volatility is showing. So what's something else we can look at? Well, let's go to skew. Oops. Let's try that again. Okay. Here we go. All right. So now we're looking at skew. Now, skew can mean a few different things. This chart here shows us the difference between the 25 delta put implied volatility and the 25 delta call. Again, we're still looking at, generally 30 days to expiration. And we're looking at, so it doesn't really matter what the expiration is. It's rolling 30-day expiration. We're just looking at what the 25 delta, so your standard kind of out of the money put compared to your standard out of the money call. Now you would expect, so normally puts in indexes are going to be more expensive, right? We already know. If you've traded options at all, then you've probably realized that if you ever trade an index, any popular index, QQQ, IWM, SPY, of course, anything like that, the puts are going to cost more than calls, right? Because people use indexes as hedging instruments. Puts are almost always more in demand than calls. And also calls are generally cheaper because people are selling them for covered call purposes. So it's normal for puts to be more expensive than calls. Now the question is, what happens when people start to worry? Well, they'll really start to buy those puts, right? And calls may stay the same, but puts will get more expensive, and this will show up in your skew, right? So you can see here, let's look at this spike here, January 29th. This was the meme stock time, right? This was when GME really took off, and a bunch of brokerages like Robinhood and stuff, they like ran into trouble with potential liquidity and how do we deal with it. So there was a brief scare in the market, right? All of a sudden, a bunch of people bought puts and SPY because they were worried that, what happens if one of these brokers can't meet their obligation? Is this going to cascade? It was very brief, right? It didn't happen for long because things got shored up pretty quickly, but there was a brief period. People really started buying puts, right? So the market itself, it didn't really tank. I mean, it was down, but it wasn't like, when XIV blew up, right? It wasn't like this huge, massive sell-off, but you could see that people really started buying puts. There was some concern there. Now it immediately went back down. Things got patched together pretty quickly. But, since then, we've had some scares, but you could see here where the you have your sort of 20-day put versus call average. And then we have your 250-day. Now, of course, the 250-day is going to be higher this time around because the last year includes a lot of the COVID stuff, right? Whereas the last, things have been a little smoother the last 20 days as we're starting to come out of the pandemic. So it makes sense that this 250 is going to be a little bit higher. So the 20-day is probably a little bit more accurate depiction of where we should be right now. And you can kind of see that, we've kind of come, whenever we've gotten a little, let's call it complacent, where puts have gotten cheaper, hasn't stayed there for long. It's kind of jumped back up. Nothing too scary though here. So, we're looking at that higher volatility from the implied back here from the, we're looking at this and let's do that. There we go. And we're saying, okay, is this an issue? Well, the first thing I did is look at skew. Skew does not really show me that it is an issue. So maybe my thesis is actually wrong, right? Maybe it's not. Maybe options are overpriced and the market's going to continue to be quiet. Right now, we're at, the 20-day moving average and below the 250-day moving average for puts versus calls. It's really not telling me anything scary is going on here. The one thing about this, though, and why, again, it makes sense to keep digging, is that sometimes the puts stay where they are, but calls get more expensive. So that's one thing that you can't just tell from looking at this, right? You can, generally speaking, most of this action is going to be because of the put pricing, but occasionally people will really start buying calls. They get excited, or they think there's going to be a bounce back or whatever. They buy calls, and that may impact this index. So that's why sometimes it makes sense to dig into that skew a little bit more. And then we can actually look at a graph here. So let's look at 30 days out. It's like the close. Let's do this. December 17th is a monthly expiration, so we'll use that. All right. So let's see where we were about a week ago. Today's was the 12th. So let's go down to like the 5th. All right. So I'm just showing the movement of skew or volatility, implied volatility, from the 5th to today. Not much. You can't see that much here. So, but what we're showing here is the pricing based on implied volatility of the different strikes a month out. So we're looking at December 17th. I'm using it a month out. So again, because I'm trying to keep it consistent with the other things we are looking at. Of course, these are static, right? I have to choose one that's a month out. We have all these different expirations. I'm picking one that's roughly a month out. So if we looked at this a month ago, we would have been looking at, whatever, the November 19th. You don't want to get the problem, just real quick. If you start looking at stuff that's too close to expiration, it'll be a lot more dramatic because of the way implied volatility moves as we get close to expiration, and it doesn't really tell you that much. So, I mean, the movement of this doesn't tell you that much because you have kind of a natural skewness that occurs in the wings as you get close to expiration. So that's why I want to go out for like a month. And so I don't want expiration to impact it. So, but what we can see here is that from a week ago, call prices. So this part's the calls. Here are the puts. You could just based on these strikes, right? You could see that call prices have come down. At the money's come down a little bit. Puts have stayed pretty stable. So what this is kind of saying, so now going back to what we were looking at, right? Puts haven't moved that much. Calls have come down. Once again, we're not really seeing anything that scares me. If we had seen calls going up and, puts going up, it may have disguised the fact that, maybe people are buying more puts, but puts have stayed the same and calls have come down. That's not really, again, it's not really showing me anything scary here, right? We're not seeing something that is saying that, maybe implied volatility has given us a hint. All right. Well, let's keep digging. Let's go back to this one. Implied volatility term structure. All right. So we were looking at skew, which is the volatility for a 1 month, one set of strikes. So we were looking at, 400 through 500, whatever the strikes that were on that screen. We're looking for all the strikes that generally trade for that, December 17th expiration or the November 19th expiration, right? That's one dimension, right? It's two dimensions, volatility and strike, but there's also a third dimension, right? That's time. Now, when we're looking at it this way, since we're not looking at a 3D volatility surface, we're looking at the money. So instead of looking at instead of looking at like the out of the money strikes, we're back to looking at the money, but we're still looking at volatility, but now we're looking at over time. So 30 days to expiration is here, 120 days to expiration is here, and then you can see the term structure in between. This is your normal term structure for kind of regular markets, right? Where you have a lot of people, selling front month volatility for income or whatever it might be, right? Short puts, short, short calls, cover calls, cash secure puts, whatever it might be, right? Not so much in the back. That a lot of the hedging takes place back here, right? People don't want to necessarily roll their hedges every 30 days. So, by 60 day, 90 day, whatever, 120 day hedges. So that's why kind of, the future is a little bit more uncertain than the present, particularly when you need to sell options to make money. So this is your term structure. We can look at how the term structure has changed, right? So from a month ago and 6 months ago, you can see that everything has come down from 6 months ago. And then from 1 month ago, again, pandemic related, right? Things have gotten better with the pandemic, less volatility, less uncertainty. From a month ago, I kind of this, to me, it's a little bit interesting because I feel that there is a little bit more uncertainty with supply chain and inflation stuff, but the market doesn't really think so, right? And maybe because we just know more of what the picture is right now. Maybe we have a clear direction on what's going to happen with rates, but it hasn't changed all that much from 1 month ago to now. What I think is really important though, is looking at how flat this curve is. So this goes from, 15 back 6 months ago, 15 to about whatever, close to 17, right? Now you're going from, 12 to, 16 or so. The steeper it is, generally, the less worried people are, right? They're, it's normal to have uncertainty about the future, but the front month is where, people are going to continue to sell those options for premium unless they're really scared, right? Unless they're worried that something big's going to happen. So the steeper term structure generally implies less concern. So we looked at skewed, really didn't really tell us much, kind of said all is clear. We're looking at the term structure, same sort of thing. Everything's kind of a bit lower. So now I'm thinking about my thesis that I said earlier about options being overpriced. Or I said the opposite, that I think that historical volatility is probably too low and that the market's worrying, and that's why volatility is higher. But everything I've seen so far is actually saying the opposite. So maybe I'm actually changing my mind. Maybe I'm thinking that I actually want to sell some options here. Another way you can look at it is, I like the different there. This is the difference between if we were to break these differences down between 30 and 60 and 90 and 30 and 120 and 30, this is what it would look like. I like looking at the difference because what it shows you is that, again, the wider the difference is generally the steeper the slope, right? So when these all sort of converge, that's usually when there's an issue. So they converge and kind of, the difference gets closer to zero or less in the case of like maybe backwardation or whatever. But so once again, everything here looks wide, maybe a little bit of barely any convergence, right? But for the most part, we're looking at what I would say is an all clear signal. So all this stuff that I'm looking at is really not showing me any real concern. So let's go back to this. So now I'm actually starting to think that my original thesis is probably not right. I mean, but obviously things can change in a hurry. But as it stands right now, if you told me, what do you think is going to happen? Is historical volatility going to pick up because, the market's going to start moving more because of concerns, blah, blah, blah. And this is telling us that, there's, that the market is wrong and that the options market is actually right in terms of, being a little bit scared? Or is this premium just too high and people are scared for no reason? I'd have to go with the latter based on the other stuff I looked at, right? That at this moment, I would be much more likely to take a sort of a shorter volatility position in the short term. So these are things that you can, so looking at this volatility of the at the money tells you part of the story, but breaking down and looking at the term structure and looking at the skew, you need to look at all these pieces to kind of get an idea of what's going into this volatility. Cause this is just at the money, right? So, and we're also looking at one instrument, right? So we might be looking at equities, and this is perfectly fine, right? We're looking at SPY and the stock market's not worried. But what if, we start looking at fixed income type stuff or commodity type stuff, and it might paint a different picture. So maybe that's where the volatility is going to be. It may, maybe this is showing some general concern, but it's actually not going to show up in stocks. It's going to show up in bonds, or it's going to show up in oil, right? So we're not going to do this now, but I could theoretically go to, USO or TLT or stuff like that. I probably better off looking at, you're probably, for those sort of things, it might be better looking at actual options on oil futures or bond futures or something like that. But I think actually the USO is a little bit different. TLT is probably a reasonable proxy for bonds. USO maybe. So, but these are things you can look at. Actually, let's go real quick. Let's just look at, just kind of curious now that I've been talking about it, before we get to ways to potentially trade this. Just real quick, let's just look at, okay. So, but you can see here where you're definitely seeing the increase in implied volatility across TLT. This is what I would expect when inflation becomes a concern, right? Because bonds are going to start moving, particularly if they expect, more rate increases, they're going to drop. That's going to increase volatility. So this kind of, again, this kind of keeps the, it kind of keeps my, it supports the thesis, right? That maybe the activity is not going to be in equities, but it's going to be somewhere else. It's going to be in bonds, for instance. So we're definitely seeing some stuff here. We could do the same sort of breakdown with skew and term structure and stuff. It's not going to be as liquid as SPY, but there is some stuff there for sure that you could do some, some research on. USO, it's actually, volatility has come down a little bit recently in oil, but again, for a while there, some of the action was in oil. Now, again, I don't know if USO is necessarily the best way to look at it. There might be maybe looking at something of energy stocks, but again, it doesn't necessarily have to just be equities where the action is, although that tends to be the first place where we usually see, any sort of real concern, with the exception of bonds, which is where apparently the action is now. So, all right, let's go back to SPY. And all right, so how do you trade this? Let's go to options. Now here, the thing about trading it is kind of the same thing about doing the research on it. There are ways, there's no right way, right? There's no single right way to do it. It kind of really depends on what is your main focus. Are you trying to protect yourself the most? Are you trying to save your capital? Do you just need to sleep at night, or do you want to make a lot of money if we tank? Or, there's different ways of looking at it. So again, there's no right answer. Let's look at, we'll go back to 30-day options. All right. So the most basic, easiest, straight up way to hedge yourself is to simply buy a put, right, at the money. But we already know, if we're looking 30 days out, we already know it's going to be expensive. And looking at it here, it's about $8, right? So now to spend $800 for one put, with time decay and everything else, and, potential Santa Claus effect and everything that we know that generally tends to happen in December. So, immediately you look at this and you're like, I don't want, I'm not going to spend $8. I think most people, institutions, most people are not going to buy an at the money put to protect themselves. So maybe they're going to buy maybe a 30 delta put, but even that, right? It's $450. That's a lot of money, particularly again, when you have time decay that'll start kicking in a few weeks. You have holidays, which tend to lower volatility, and so, it's like, what do I do here? Well, this is where you could start looking at different spreads. Again, the easiest thing to do is a simple vertical. Your starting point is going to make a big difference, of course, but let's just stick with 30 delta as a starting point. You're buying the 30 delta and maybe selling the 20 delta. let's round it to $10. So we did 455. So we'll do 445. All right. So this is your basic put spread. Instead of spending $450, we're spending $150. Now this is a lot more reasonable. Now, if nothing happens,
Jay,
we've lost 100.
When you're
Yeah.
Jay,
Yeah,
when
go
you're
ahead.
entering that trade, what do you look at the midpoint to try to get it off? Do you try to get it off at the, where do you try to get it off relative to the prices when you enter something like that?
Well, this one's super easy because they're only 1 penny wide.
There you go.
But,
it's SPY. You're right.
Yeah. So, but yeah, generally I put my prices in. I mean, if it's a midpoint, I might put it like 1 penny higher to start. So, I mean, this one's fortunate. I mean, you just obviously pay the ask because there really is no spread, which is pretty amazing. But that you can go, you can go 31 days out and get an out of the money put spread and basically not give up any edge because they're 1 penny wide. But this is SPY, and we know that's unusual. But let's say the market was 150, 160. I'd probably put it in at 155 or maybe 156 just to make the market makers feel it's not the market maker. It's actually going to be an algorithm that fills it. But, you could pretend like it's a market maker and you're giving them a penny edge, right? So, but yeah, I almost always put my stuff in at mid-market first, and then I'll move it slowly towards the ask on a buy. So, but you don't need to worry about that, fortunately, with SPY because it's so crazy. I mean, it's still amazes me as a former market maker to see penny wide,
No, that algorithm you're training against is a good one, right?
Yeah, exactly. They're making a half a cent, 1 trillion times. So I guess that's still good, right? But yeah, all right. So instead of spending $450, you're spending $150. Now that's something I could probably live with. If I'm sleeping at night for the next 31 days, and I lose $150, and I know that if we drop that, first of all, if we plunge, I'll make $850 on $150, which is a nice risk return. I mean, it's not, it's still, it's a current. So we're at 467. So it's not like you're doing the eyeball test, right? Starting at 455 is when it starts to kick in, and we're at 467. That doesn't, it doesn't look like a big drop, right? And it's not, I mean, you don't feel like this thing needs to plunge into oblivion for you to make money. It seems like, all right, well, if we have a couple of days of selling off, we're going to be here, and and even if it keeps going, we have decent upside. So this is the sort of trade I would do, right? Something exactly like this. Now, there are times though where even this is going to be more expensive. If volatility was a lot higher, this thing may be double. And now maybe we might be talking about $300 for this spread. I'm like, now I don't know. I mean, it's far away, but if we drop all the way through, I'm making 700 on 300. That's not quite as good as a risk return. All right. So now you might do something like, let's add a, where are we? 445. Let's do 2 of those. And then we will add a 435 here. All right. All right. Now we have a butterfly. Okay. So now this thing costs us about 60 cents. All right. So of course, again, with higher volatility, this would be more, but let's just say it costs $1 instead of 60 cents. All right. Now your issue, of course, with something like this is that you have a $20 range where it could make money. But you could do this wider. I'm just doing this because I already had those things. You can make this, we'll look at one in a minute here, but let's just start with a $20 wide butterfly. If you might look at a chart and say, well, it hasn't been any lower than this year than this range. So I feel pretty comfortable with that. Now you're probably not going to end up in the middle, right? And make $9.40 or whatever, but all you need to do is be somewhere in this range for this to make money. It's not quite as strong of a hedge, but it may help you sleep at night. And it only costs 60 cents. Again, like you could put this on and say, screw it. I'm not even that worried. I'm going to forget I own this thing. I'll look at it, the day before. And, now another way to do these is, of course, let's just let's just see what it would price out at it if we did this as 20 wide, just out of curiosity. All right, so that's 20, 20, 20. Just making sure I have it equal. All right, so now we have $1.50. So now this was the same price as that vertical spread we are looking at, but it gives us this range from 454 all the way to whatever 416. So now we have a much bigger range. And so this is a way to have your butterfly act more like a vertical spread. If it's wide enough, then it can drop into this range, and really now you're talking about having a major sell-off in the course of a month that blow through this. So that's another way to use a butterfly. Maybe instead of a vertical spread, gives you a little bit more upside potential if you keep selling off, but still keeps the costs at a reasonable point. All right. So now you have three different things you can do here. You can buy a put.
Hey, Jay.
Yes.
We did have a question that popped up, which is relevant. Stephanie was asking, it's a two-parter. First, when would Jay choose a spread versus butterfly? How would you make those adjustments? And she's, and I'm sure this is, I don't know if you and Mike traded together, but I know Mike was on the Amex for a while. Mike, who's a CNBC contributor, he says that with a spread, one should collect 1/3 of the width of the strikes. I don't know if you agree with that statement, but is that something you look at when you do spread? So it's a two-part question. When would you choose a vertical spread versus a butterfly, and how much premium, I guess, would you like to take in on that spread?
Yeah. Both great questions. So I was actually just about to get to the first one, which is, so with the put spread and the butterfly, some people have, like I said, I know that there are some people who have kind of like a formulaic way of doing this, right? Where they say, okay, in X situation, I'm going to use one, I'm going to use the other for, I'm not quite so rigid on it. I'm more of I'm going to look at it and see what feels right to me. So, which is a little hard to explain, unfortunately, but there's a bit of an art form to it, right? So for me, like, if I can do a vertical spread, usually that's what I'm going to choose, because puts are almost always too expensive for me, in my opinion. If you buy puts that are close to the money at all, they tend to just be really expensive. It's just overgeneralizing, but that's usually the circumstance. I like vertical spreads are simple. They're easy to put on. You don't have problems getting in and out of the trade. So that's usually my first choice. However, if that vertical spread feels too expensive to me, and again, that the feel part is kind of like, you have to gauge the situation. Are we on the verge of, is there a lot of chatter? Are people really worried? Has there been a lot of volatility, right? That might be a situation where, you're like, okay, well, I'm willing to pay $3 for a $10 wide vertical spread or whatever, instead of $1.50. So you kind of have to gauge the situation. But let's just say, we're in a normal situation right now. I think $1.50 for that first vertical we were looking at is perfectly reasonable, right? But let's say that was $3, and I'm like, this doesn't feel reasonable given the environment. I'm going to switch that to a butterfly. Now, what Mike is saying, yeah, he's kind of using that, the rule of thumb, and I think that that's reasonable. If we were sitting down and I was doing this, and I'm putting money down on this position or recommending it to my clients, yeah, I'm going to do there's going to be a little bit more math involved in, I don't quite have the same structure, but I'm definitely I'll probably look at the risk reward ratio. Like, I'm looking for a 1 to 4, or what I think what Mike was saying was a 1 to 3 or something along those lines. I something like that. I don't have a set number, but it's definitely going to be, I'm probably not going to do a 2 to 1 payout, right? It's going to at least need to be a 3 to 1, probably more like 4 to 1 is usually what I'm looking at. Butterflies are a little bit different because it kind of depends on how wide you can get, right? Like, when I do a butterfly, and I love out of the money butterflies, I'm a huge fan. But what I tell people when I put these on is that I'm never considering ending up at the center strike, right? Because that almost never happens. Ending up in the center, particularly on a wide spread, is nearly impossible. What you're looking at with a butterfly is a higher probability of ending up in a range, right? Where you can, maybe at the very least double what you've spent on it and hopefully more, triple or whatever. But the key is that you're trying to keep your costs low and give yourself a range. Now, usually I don't use these. I use directional butterflies usually more for bullish type stuff, but they can be very powerful hedges when volatility is high. And I think that's the key, that if you feel like you can't find a reasonable vertical spread, which will give you a 3-to-1, 4-to-1 payout or something like that, then you need to do a butterfly. So at least you can sleep at night and, pick a level that you feel like it's not going to blow through. Right? And we, levels and indexes are not, obviously, you don't expect the market to go down 10% in a day. Like, for the most part in a month, you could probably pick a level that's reasonable, that you feel reasonable about, that it's not going to blow through. So, I don't know if that, I hope that answers the questions, because I keep saying there's a little bit of an art form to it. And unfortunately, that's true. As much as I try to tell people that, I like to have rigid rules, I don't, because situation changes. And whenever I try to in the past, when I ran services like Iron Condors and stuff like that, and I tried to always stick to the same rules, it never worked. Like, I realized that you have to use a little bit of your feel for the environment. And that's why I really like to look at these things like, like the term structure and the skew and these other things, and kind of put all the pieces together. Another thing that we don't have here is VIX, and we can't see it. And Will, please tell Dimitri to put that in.
I will mention it. It's been mentioned quite a lot.
I know. I'm not, honestly, yeah. and I know SIBO charges an arm and a leg for VIX data. So and we don't want to have to up the prices of Market Chameleons. but
and it's how many people will look at it, right? It's right. A piece of what we use, but it's not. We don't trade right. There, so we do get requests for it, but it's one of the things we're looking at. There's a long list along the line of theoretical edge. We have two questions. I'll read them both, and maybe you can just talk about how you look at overpriced versus underpriced. The first question is, Jay, how much do you consider theoretical edge when constructing your spreads? More or less important when trading pure price action was that. And then someone else, do you ever look at overpriced or underpriced strikes when looking for vertical spreads? So those are kind of two questions that you may have one answer for, but give it your best shot.
These are great questions, and the answer is that if I was sitting at a desk at an institution, 100%, that's what I'd be looking at. I would be looking at the surface. I'd be looking at the volatility surface, and I would place my I wouldn't just go to 30 delta and then sell the 20 delta, right? Like, I would look at theoretical edge / volatility surface and pick strikes that I feel are the most overpriced or underpriced or whatever it might be, depending on if I'm doing a spread. I'd also have my own theoretical model, but I'm not doing that, right? I'm working with, the vast majority with retail clients, and we don't have, not only do we not have access to a lot of that stuff, but honestly, I don't really think it matters when, you're dealing with a group that is not going to delta hedge. You're not going to be looking at this stuff. What you're looking at is something, generally speaking, that's either going to help you sleep at night, or if you think the market's going to go down, to help you make money. Now, if that is the difference between the 459 and the 457 put, that's not really going to matter. Right. If I'm doing 1,000 of these, yeah, it's going to matter. Right. And it's going to matter again, if I'm delta hedging everything I'm doing. And, this is where that stuff matters. And I don't, it's like, Ewan Sinclair, has written several, famous books on the subject, and he, and I talked to him about this on theoretical edge. And he's like, his opinion is probably, you're not going to out predict the models that are already out there, the Citadels of the world that probably go 9 derivatives deep on their on their pricing models. Like, we're not going to outcompete them, right? We're not going to have a better theoretical edge than the market makers doing this. So do what is going to be cost effective within your own budget, but will also help you. I'd say more likely, let's say if you have, you want to protect $10,000, pick how much of that you want to protect or how much it will cost you, and base it off that. Right. So do the practical, and Mike and who's watching, some people who are, have more experience might be, rolling their eyes at this, but I try to really push the practical aspect of it, because in the retail world, people have a budget, right? They're not going to necessarily, the best spread may not be the one that they can afford to put on. So they're going to do something that's maybe suboptimal, but they'll sleep at night. Right. So that is generally my advice in these situations.
Yeah, that's great. That's great. We had a question about the volatility surface. I think you already showed that on Market Chameleon, didn't you? Where it exists?
Yeah. There's another thing. Tell Dimitri that we would love a 3D volatility surface. Yeah. You can look at the surface. Here we would look at it in two parts. You would look at the skew.
I think you go to the skew, and then a comparative analysis will probably give the closest.
Right. Yeah. So you can compare. So this is going to give you your, essentially the closest thing you're going to get. Now, it's not a 3D version, but honestly, like you could get pretty much everything you need out of here. You can also then look at the term structure separately and kind of, so really this combined with the term structure with this is your 3D surface. Again, like I've been trading options for 20 years, and I don't regularly use a 3D surface because I'm not delta hedging stuff. Like, I'm not looking for optimal strikes. We're generally, with retail, we're looking for the most practical way of trading. So, volatility surface is extremely important if you're delta hedging and you're putting on really large positions. But, when you're putting on a general hedge or a general bullish position, you can kind of just eyeball what strike might be the best, right? And that generally is what fits in your budget and how much you really want to make on it. So, again, not as scientific, and that's where kind of the feel comes in, but there's only so much you can do when you don't have access to endless pile of capital and institutional rates and everything. So
now we did have two questions. One question was about, and I'm assuming you used it as an example, but Trevor was asking, why did you use a put spread and not a call spread? And then at the same time, someone put in a question, the call butterfly is cheaper than the put version on SPY. I don't know if that's the case, but that's what Mark's saying. So
yeah, no, it might. I use, so for put spread and call spread, theoretically you can do, deep in the money call fly or whatever and have the same impact, and it might be cheaper. And if there's an obvious difference, obviously you're going to do the one that's cheaper. Usually, again, though, when I'm putting on, let's say, something like a put butterfly, which is already going to be more complicated for most, for most practitioners that are retail traders, for them, intuitively, puts make a lot more sense. And if there's a huge disparity, right? If there's $1 difference between the call and the put, then screw confusing people. We're going to do that, right? But if the difference is 10 cents or whatever it might be, I try to do what's most intuitive. So, I know my people are going to think puts for down and calls for up. So that's what I want to do, because I think what I've noticed is that my people don't make trades if they don't understand it. And whenever I try to mix stuff up in there, I've found that people just don't do the trades. So I really try to make things as intuitive as possible. And again, that's not necessarily optimal, right? And but at the end of the day, what's going to matter, right? Having the trade on or not having the trade on over, because of a 10-cent difference. Right. So these are things that I have to weigh in my business. So it's a little bit personal to what I have to deal with, but yeah. So I probably wouldn't even look at that again. If I'm putting this in my own account, I'll compare the call and the put fly. Right. But if I'm looking for my people, I'm probably not even going to look at the call fly, because I know that that's going to be super confusing and they're probably not going to put it on.
Yeah, that's interesting. Mark was saying, who asked the question, he's saying when he sets up a put spread, he flips it to a call and compares the price risk graph. And
that's a good idea.
And
actually, I think
that's the great thing about the stock market and the derivative, the options market, is everyone builds, a different trading style and something they're comfortable with, and people try to learn from each other. So that's all good stuff.
I think that's actually, Mark, I appreciate that, because I think I might actually do like a lesson on that. That's a really great point. That's something that I haven't really discussed, but I think that would be a great lesson. And I try to do lessons in my webinars and stuff like that. So thank you for bringing that up. I think I will do that in my next
one. That's perfect, because that's been an hour. And I have put the link. I found a link that I have for you for your checklist, and people have asked for it like 3 times on both the chat and in the Zoom. So I put that in there. Is there anything you want to share with the community where they can link to you? Or, I put your checklist in the box. Is there any
checklist is a great place to start it. I really like that checklist. It's one of those things that is the link's not working.
That's strange, because it worked for me. Well, if you want to take a second and find the link and put it in,
let me see.
I tried it and it worked, but I apologize for that. I spent a while searching for it, but if you have the link.
Yeah, it's not working for me. I don't, yeah.
Let me see. Is it?
I have to.
Let me check. Let me check real quick, because I'll try it again, and maybe I could have copy and pasted it incorrectly. I'm not that skilled at copy and pasting. I apologize about that, Jay.
No worries. I think the one I have access to is behind a paywall. So
I just tried it again. Everyone, I'm just going to put the pure link with nothing else in there and see if that works. I'm putting it in both the YouTube chat, and if not, Jay can share something with me and I'll attach it to the YouTube, and I'll put it in tomorrow's mailer. So I'll put it, for those who don't know, MarketChameleon.com has a YouTube channel. Every morning, Dimitri, the co-founder, myself do a live show. So we have everything is downloaded on the YouTube channel. So I'll put the link if this one doesn't work. Did it work for you, Jay, this time?
Yeah, it worked.
All right. So that link I just put into Zoom should work. And I will put this link on the YouTube channel as well. And I will put in the email tomorrow morning. And Jay, we'd love to have you. If you ever want to get on, if you're doing a webinar or something, you want to come on and promote it in the morning, we do it every day. So just let me know and I'll have you come on and talk about what you're going to do that night or something.
Yeah, absolutely. Yeah. I said, I know that this was a little bit, say more on the theoretical side. So I'm curious. I'm going to check out the YouTube channel and kind of curious if you have a chance to give your thoughts on this, because it's something that I've just recently started discussing about, kind of looking into these different, parts of volatility to put together a picture, and then also choosing which kind of trade you want to do. And I'm very curious about, what everyone thinks about that, and if they look at it the same way and what kind of hedging they do. So if you want to contribute on the YouTube channel, that would be great. I'll check it out after this and I can chime in as well.
I'll put that link as well. Hopefully people can go right to it and get to the channel, but the link is both now in the YouTube chat and in the Zoom chat. People go over, leave your comments for Jay. You can always email support@MarketChameleon.com also for anything you want to get to Jay. Or Jay, do you have an email address you want to give the people if they wanted to reach out to you directly or not?
Yeah, here, I'll put it into chat here.
It's been too long, by the way. I think it's been almost half a year since we've been together. So
do you have any more of those my kids broke my Market Chameleon mug. Do you have any more of those? I got
Yes, I do. And I'm sure I can scrounge up your address in Arizona again and send you another.
I was really bummed. I'm like, guys, I can't replace this. J.Soloff at Investors.
You know, the only place I won't send it, I won't let it out of the country now. I've had more returned $50 MarketChameleon mugs because I've sent them to like Czechoslovakia. I broke 3 on the way to Malaysia. We have a great chameleon. He's one of the first regulars on our morning show. He actually does a webinar too. The doctor. I sent 3 packages over before one finally arrived. One arrived broken, one never got there, and then the third one finally got there. So only cups in the US now. And Jay, you'll get one soon.
Arizona is
all right. There's Jay's, and I'll copy that email address and put that in the YouTube chat as well. Thanks so much, Jay. You were great. Very much.
Thank you. Appreciate it. Always a pleasure.
Awesome. Actually, Chuck, who's one of our regulars on the morning show, says, "Great, Jay, my original mentor." That's Chuck from Minnesota. We love Chuck. Thanks, Chuck.
Wow.
Actually, on the morning show, he's known as the Swami because he always comes in with some great commentary.
Thanks, guys.
All right, my friend.
All right.
You have a great evening and a great Thanksgiving, my friend.
Thank you. You as well.
All right, chameleons. Thanks for joining us, everyone. Check us out in the morning, 9 a.m. for our live show. Jay, you're welcome.